The market is crashing, everyone is panicking, but it actually is an opportunity to build long-lasting wealth. Hi, I'm Selena, I'm your new finance BFF, and in this video, I'm going to give you an investment strategy that actually works. I'm going to tell you exactly what you need to be doing to protect your money and to multiply it in the long run. Let's start with the basics. What even is investing? Investing essentially means that you use your money to make more money. Now, why should you be investing? Surely it's not that easy, right? Now, it actually sounds quite risky. I'd rather just save my money and have it sit in a bank account because this way I can't lose it, right? Wrong. There are two major reasons why you should be investing. Number one being inflation. Inflation essentially means that your money is losing value over time because prices are rising, but the money sitting in your bank account doesn't. So in the long run, you actually lose your money. And number two is you can actually build wealth quite easily. If done correctly, people saw their investments grow by 8 to 10% per year on average. But how does the stock market actually work? When you buy a stock, you essentially buy a small piece of a company. So let's say you buy a share of Sephora. You now own a very tiny fraction of Sephora. Buying a stock is basically you saying, I really like the product that this company is offering, and I believe that they will grow in value over time, and I want to make money from that growth. And once a company has decided that it wants to start offering shares to the public, you can buy these shares in the stock market. The stock market is basically the place where people trade tiny fractions of thousands of different companies. There are two main ways that you can make money in the stock market. Number one being capital gains. Capital gains means that your investment rises in value. Let's say, for example, you buy a stock for $10 and it rises to $70. You take profit, meaning you've made capital gains. And number two being dividends. Some companies decide to share their profits with their investors, giving them regular payouts. And this is the company's way of rewarding their investors and encouraging them to keep investing into them. Okay, now let's address the big question. What should you actually invest in? Should you invest in Apple? I mean, it's one of the biggest companies worldwide and it has been successful for ages. I mean, yeah, you could do that. It's just a tad bit risky because even the biggest and most successful companies can go through years of struggle and hardship. Therefore, most investors do not try to pick this one company among thousands of companies that is going to perform amazingly in the future. What they do instead is they buy multiple big companies all at once through index funds. An index fund is basically a basket full of multiple different big companies. So, for example, instead of buying Apple, Tesla, or Microsoft, you just buy an index fund that tracks the S&P 500, which are the 500 largest companies in the US. So if some companies go down, but others go up, you will still profit from the general upward trend of the market. And this is how you diversify your risk across companies and also industries. How do you actually start investing? So first, you need to choose an investment platform. This is where you are going to buy and manage all of your investments. I personally like Trading 212. And then you need to add money to your account. This is usually done very easily by, for example, Apple Pay or bank transfer. And then you can choose your investments, such as index funds. And I also recommend doing automated investments where you basically automatically invest a specific amount of money per month instead of waiting for the perfect entry. Because over time, in the long run, this actually averages out the highs and the lows of the market because some months you buy higher and then some months